So are you curious what I have invested in this journey to financial independence that allowed us to retire early? Well, today is your day because I am going to open up the pie chart and show you the accounts that we are invested in. So I hope you'll join me. Hey everybody, it's David from David in Progress, where we talk about financial independence, retiring early, and living your best life from the perspective of someone who is doing his best to do all those things. Okay, so today I am going to go over all the mutual funds, all the accounts that I have investments in. I want to do a big disclaimer. I am not a financial planner, and I am not someone who has trained financial expertise. I am a person who has read a lot of books, made a lot of mistakes, listened to a lot of podcasts, and done quite a few different things over the years. So this is not an advice video. This is truly just opening things up to show you what I am currently doing with a lot of caveats along the way. And I'm going to do this in a rather low-tech way. I'm going to pull up some screenshots of charts I've made and screenshots of various funds, and we're going to talk about it. So let's start out with just a general pie chart showing all of our investments. And you can see from this chart that I have 8 mutual funds currently. I am a mutual fund only person. I have only one individual stock, and that is in T-Mobile, which is leftover stock from when I was an employee. But everything else that I have is all in mutual funds. And the reason is simplicity. I tried the individual buying stock thing 25 years ago, and it was just too volatile for me. Picking the different stocks, it just wasn't fun in essence. So then I transitioned over to mutual fund investing. And even before the book, The Simple Path to Wealth, came out, I just kept things simple. Things that I looked for when picking a mutual fund, obviously the first thing that I looked for was returns. You know, what are the returns in the mutual fund year to date, 1 year, 3 year, 5 year, 10 years, going all the way out. And I wanted to make sure that every fund that I picked had a high return at the furthest date out, long-term results. I also, even back in those days, looked at expenses. I chose only Fidelity funds, and I only chose funds with a very low expense ratio. And I'm so glad I did. So let's look at the first one, FXAIX. This is Fidelity's 500 index fund, meaning that it basically is a tracking fund for the S&P 500. This particular screenshot that I'm sharing with you is looking at the fund within my Fidelity account. There's other ways to look at it. I love the Fidelity view, probably because I am just most used to it, but I think it really shows you a lot. So we're going to start at the top and work our way across. The first thing you'll see there is the year-to-date returns, which this one, as of the day that I pulled this information, was at 15.81%, which I don't think anyone's going to argue that that is a really good return. It has a Morningstar rating, which I honestly don't pay a whole lot of attention to, but it has a really good one of all 5 stars. You can see there the returns are high, expenses are low, and then an important thing there is the risk of this category of investment. Over on the other side, you see the actual performance. So I mentioned year to date is 15.81%. Look at that annual average return, 28.18%. 3 years, 9.55. 5 years, 15.79. 10 years, 12.68. So basically, you could look up the returns for the S&P 500, and that is going to be the return for this account, which is 38.2% of my portfolio. So the vast majority of my holdings are in this one account. The other thing that's critically important, if you look down at the bottom, is expense ratio. This account to have is very inexpensive. One of the things that I like about these low-cost index funds is the low expenses. And you can see the expense ratio gross is 0.015%. And that is fantastic. There are funds out there with much higher fees and lower returns. Why in the world people choose those funds is just beyond me. This is a very simple index fund. If you follow the simple path to wealth, this would be one of the key accounts that would be something that you want. So we're going to skip FNILX. Small balance in it is kind of an experiment for me, so please feel free to look that up. Next, we have my next largest holding, which is 18.4% of my account. It is the Fidelity Zero Total Market Index Fund. Now, where the 500 Index Fund concentrates on the S&P 500, the Fidelity Zero Market Index Fund is, in essence, a total market fund. And this one is proprietary to Fidelity. And it says total market, but it's truly not total market. You can do some research yourself and see that. And this one's different because it's unique to Fidelity. The thing that makes this fund so fantastic is it has zero fees. Isn't that amazing? So a fund like this with Fidelity, there's no minimum balance to get in. You can throw 50 bucks in. You're not going to pay any fees to have the account. There's no expenses associated with it. Whatever grows within this fund is yours to keep, of course, minus all taxes and those kinds of things. And that makes it fantastic. So let's look at the year-to-date growth of this fund, 14.08%. And that is really good. The 1 year, 27.89, 3 years, 8.04, 5 years, 15.11, and the life of the account is 12.43. This is a fairly new fund. It has not existed for a super long time, so take that with a grain of salt when you consider the life of the fund. But these are my two core funds. As you can see, the balances that I have in them. I have the majority of my savings, our savings, in these two funds spread across all of our accounts. That's one of the other things I like about Fidelity. We have our my 401k, my legacy 401k from my previous employer. My wife's IRA is with Fidelity. My HSA is with Fidelity. And we have two Roths with Fidelity. One of the things that I do is I have a spreadsheet with all these accounts. I'm trying to keep things simple. And I view our investments as one big account, even though we have multiple. All right, let's move on to the next one. And this is a bit of a legacy account. It is one that I've had a very long time. And once I go over it, you'll understand why I struggle to let go of it. It is the Fidelity Blue Chip Growth Fund. And I have this in my 401k, and I also have it in my taxable brokerage account. Look at that year-to-date result, 28.11%. That is just fantastic. Go further over to the right, and you'll see the average annual return currently is 44.69%. 3 years, 9.54%. 5 years, 22.17%. And 10 years, 17.49%. This one has a higher expense ratio relative to my other funds. You can see that at 0.48%. However, in my mind, those high returns are making up for that slightly higher expense ratio. All right, next fund. I am going to talk about this one, even though it is a small part of my balance. I wanted to have some more exposure directly to technology, so I do have a NASDAQ Composite fund, which is an index fund tracking the NASDAQ. And looking over the results, you can understand why. The year-to-date is 19.4%. And if you scroll across, you'll see the 1 year 30.74, 3 years 7.83, 5 years 18.60, and 10 years at 15.77. And as you look at my original chart, you'll see this is also one of the smaller balances. But I really like this account. It's been doing great this year, and I love the exposure to technology. You can see the expense ratio on it. The gross expense is still fairly low at 0.34%. Next, we have the Fidelity Balance Fund, which is one of the legacy fund accounts. It's one of the accounts that I've had for a very long time. And one of the reasons you can see is fairly conservative. If you look right underneath the brand name there, it says Fidelity Fund Pick. Back in the day, I didn't choose any funds that were not within the Fidelity Fund Pick. And Fidelity has things where they help suggest, and those were always very helpful to me and make me have more confidence as I was picking funds back in the day. The year-to-date return on this one is always going to be lower than my S&P 500 due to the balance. This is a mixture of quite a few things. You know, there is bond funds in this, there's cash, there's some foreign stock, there's some other things. You can look deeply in it and see all that. So it's a very conservative fund. I do still like having it in my mix for that particular reason. You can see the year-to-date returns are 10.71%. 1 year, 19.41%, 3 years, 5.06%, 5 years, 12.01%, and 10 years, 9.40%. And the expense ratio on this is one of my higher ones, also at 0.47. And my legacy mind is still hanging on to this one just for the balance, since I know that I could sell this fund and spread the money out and create this own balance myself, which is something that I am considering to do in the future. So those are basically all of my equity fund accounts. So as you are designing your account for, especially in retirement, which is where I am, it is time to become more conservative. Things are great right now as of the date I'm filming this video as far as the stock market return, but a crash is coming. Make no mistake about it. They come every few years and then they last a little while and then the stock market goes back up historically. And so a crash is coming. And especially in my retired life, I want to make sure that I have a bit of a cushion for when that crash comes. And the core for that is bond funds. And so the FXNAX is my core Fidelity bond fund, with the exception of what I have within my 401k. And we'll talk about that next. And you can see in comparison to the other accounts, the year-to-date return 0.19, and it just recently turned green. I haven't seen it green in a very long time. The average annual returns 1.24%, and then you see all those reds, and you go out to 10, it's 1.22%. Expense ratio on this one is 0.025%, so very low expense. So this is that I'm not going to make a lot of money off of fund. This is a wealth preservation fund. Money goes in here just to protect it. My bond fund within my HSA and within my Roth are in this. The majority of my bond funds are within my actual 401k, and that's a proprietary fund to the 401k that I have. We'll discuss that in just a second. And you see over here, I have 8.7% in a total bond market index trust, which is something proprietary, very not unusual at all in 401k accounts to have these funds that are proprietary to your 401k. So this is called the Vanguard Institutional Total Bond Market Index Trust. And you can see it's very similar to that Fidelity bond fund that I just showed you a moment ago. At year-to-date return at 0.23%, average annual returns at 1.44%, and then you can go on. Very low expense ratio at 0.020%. So that is it. Those are our various asset classes. You'll notice one of my bigger pieces of the pie is the cash. I do feel like from a conservative standpoint that I'm not. I have a very aggressive portfolio here, and I'm gradually doing some shifting to make it less aggressive. I do have a very large balance in cash, and that is typically not a good thing. However, I have it in the market fund within my Fidelity account, which is currently yielding close to 5%, which is really good. So for right now, remember how much the bond fund was yielding? For right now, I'm leaving it in cash because of that close to 5% return. And at some point, I'll move more out of cash over into the bond fund for that particular cushion. But for right now, I feel very comfortable having that position in cash. That is all of our various funds that we have. I am on the path to simplification. I do hope at some point to consolidate. 8 funds to me is just a little too much in my mind. I'd like to get it down to 5 or so. And I think that would be great. Now, one final thing to share with you. I'm going to show the actual returns for this portfolio, at least versions of it. I have changed it over the years, going back to 2011. I very much hope that you are tracking your net worth and your returns. It's just amazing. I don't have the returns every single year, but I do have my account values going back over more than 20 years. And it is just so motivating to see, looking back and talking to past me and seeing the decisions that I made each year or we made as far as how much we were saving. And then when you turn the corner and things just kind of skyrocketed, it's just very exciting. It's very motivational. So I'm going to pull this up for you. We're going to walk through it just real quick. So starting in 2011, you can see a small return there. And then look at that, 12%, 17, 7, oh no, 2015, there's a bit of a crash. Following year, you go up 5.4%. In 2017, 21.8%. 2018, there's another drop in the stock market, negative 4.2. But look what happens after 2018. A 29.4% return. 2020, 24.71% return. 2017, 17.60. And then we get to 2022, that was not one of the better years at 18.84. In 2023, 20.11%. And then year to date, as of the day that I'm doing this video, I am at a 12.18% return. So very exciting. And my entire planning as far as retirement and everything is to live off of, I always have modeled that out very conservatively at a 6 to 8% return. So if you look at these returns, I'm far exceeding that. And I do have it in my mind that in the future, that will all go away. So I'm transitioning to more conservative in the future. But for right now, these last many years, it's been an awesome run. The key is when you get to a 2022, when it's down 18.84%, is to not panic. Where, people panic and they sell and, oh, don't do that. The beauty is, if you are charting over many years, you will see that about every 3 years, there's a tremendous crash. And then in the years afterwards, the stock market comes back up. Of course, past performance doesn't guarantee future returns. But if you are tracking things in this kind of way, it can give you confidence. Confidence is very key when it comes to taking care of your finances. So I hope this was helpful. I hope sharing the various funds that we have our investments in was helpful to you. What do you think? Is this a bad portfolio, a terrible portfolio? How does it compare to you? What questions might you have about the investments that we have our money in? Love to hear from you. Leave a comment and I would be very thankful. I'm especially thankful for those thumbs up, those comments and the shares. You really help the channel if you do that. Thank you so much for being part of this channel and for being part of David in Progress. Thanks for watching.